We are well on the way now into the afternoon. Stocks are at the highs of the session. We've got a nice little bullish thought there for the year-end period from Arnhem Holzer. Let's get into some sectors with Sean O'Hara, president at Pacer ETF Distributors. Hey, Sean, welcome back to the show. Let's get into a few specifics here, a couple groups that you're watching. One you like, healthcare. Let's talk about it here because it seems like lately it's been super hyper-focused on all the weight loss drugs.
Well, yeah, I mean, that's the short-term story that, the weight loss drugs have been, sort of a big, influence on the healthcare stocks. But generally speaking, longer term, I mean, the healthcare as a sector is a great demographic ages and as the other sort of developed economies around the world age. So we've owned healthcare for quite a while here. It's been a little bit of an overweight, and it's certainly helped our portfolio returns.
Now, the big biotech plays of the last couple of years that were very like COVID specific, some of those have still been getting hammered, Pfizer, Moderna and stuff. So we've got like some pretty big divisions. We got a few big winners. We got a few big losers in the group. Does that leave the sector kind of spinning its wheels, or you think we'll get something to really drive us to a breakout here?
If you look at a name like Pfizer, I'm choking to death here, Oliver. Sorry.
It's all right. You can take a sip.
Pfizer is one of our big holdings, and they're sort of packaging the COVID vaccine with the traditional flu vaccine. So I think that could be a good source of revenue for them going forward that goes beyond COVID. And then they're working on a sort of a pill form of this Wegovy, Ozempic type drug that could be an easier, more tolerable way to take those kinds of medications, and they continue to have a pretty broad pipeline and generate obviously quite a bit of free cash flow and free cash flow yield.
Shares getting pummeled, but then you've got some big success stories on the other side, like an Eli Lilly trading at 52-week highs. You got a big group of companies that are trying to make breakthroughs on all the weight loss stuff. How much do you think that's really going to like change the world? Is that part of the thesis, Sean?
Not generally. We just added Pfizer. So, obviously when you can buy a stock like Pfizer that's a high quality global brand that generates an enormous amount of free cash flow and has the pipeline that they have, and you can buy it at 60% off, as the chart before just simply showed, those are the kind of things that the screens that we use, which are free cash flow and free cash flow yield, sort of point you to. So I think it's a stock we've owned and not owned. We've owned it for a while, made a lot of money on it, and then it tends to go up, and we rotate it out because the price has gone up too high, and then it sort of comes back down to earth. And so Pfizer's a name that we like, but we're not married to it. We buy it when it's cheap relative to its free cash flow, and when it goes up, we get rid of it. We own other healthcare names, like we own McKesson, have owned that forever because they're just a cash machine or cash producing machine, and so they're on the distribution side of healthcare.
We're on the potential here sector-wise to get to a fresh 52-week high. Are these companies that weather the storm if the economy turns south, and then do they participate if the economy stays stable? Should it be like a win-win, or how do you think about them connected to the macro?
Well, I think from the macro perspective, whether the stock market's up or down or whether we have a recession or not, people still need healthcare. So that's just one of those things like, utilities tend to do better in a recessionary period because we're not going to take a cold shower in the dark. Well, same thing's true with healthcare as a service. I mean, we're going to continue to need solid healthcare. Medications are going to have to be, continue to be taken. So they tend to be able to be a little bit more defensive during those periods of time. And then obviously when the cycle moves up, everything sort of goes with it.
Okay. Now, another group it seems like that you may be worried still has some pain, maybe connected to the economy, maybe on its own, is in the real estate category, commercial real estate. Are you just keeping those companies out of your funds right now, or what do you think we should be looking for here?
Yeah, so real estate, and I'll add to that, broad-based small cap indexes have the same basic problem, and that is that they're rate sensitive. And so with the real estate market, there's about $1.5 trillion worth of commercial real estate mortgages that are going to roll over the next 12 to 15 months. And they're going to roll over at much higher rates than they were originally financed at, number one. Number two, the buildings are like 60% occupied, so the assets are going to have to be marked down. And so we think there's probably going to be a pretty big squeeze on the commercial side for a while. And so it's not really the time to be a commercial real estate investor. At some point, it'll be a real opportunity, but you have to let things sort of shake out, if you will. That means, if you're going to be a real estate investor, we would favor being real estate investors in, say, data centers and cell phone towers or distribution type real estate that, that connects the supply chain and makes e-commerce possible. I mentioned small caps a little bit. We're taking in a lot of money in our small cap strategy right now, but it's only because we focus on the 100 stocks with the highest free cash flow yield. If you look at the broad indexes like the S&P 600 or the Russell 2000, somewhere around 30% of the names in those indexes, A, don't make any money, and B, are more highly levered than large cap stocks. So somewhere around 30% of the earnings of those broad-based small cap indexes are currently being used to finance debt, because most of the debt they finance is this 90-day stuff. And so as interest rates have risen, it's put a real big pinch on those small cap names. And that's only part of the problem. The other part of the problem is the other half of the debt that they have is, that's going to eventually roll over, which is more long-term in nature, is going to roll over at higher yields. And so when you use the screen we use for small cap, which is free cash flow and free cash flow yield, we're only spending about 6% of our earnings financing debt versus roughly 30 for the broad-based indexes. And so I know a lot of people think that, it's time to push into small caps. I would agree with that, given the return differential between large and small cap over the last several years. But what I would say is be very, very cautious about how you do that and be very, very selective. Don't buy the broad indexes, because I think they have a couple of challenges that are sort of similar to the challenge that we just described on commercial real estate.
Sounds like you believe the days of buying unprofitable companies is basically over at this point.
Well, when you have zero interest rates and money's free, lots of stuff works.
Sure.
Right. And when, we get interest rates to where they are, which, by the way, I think is, kind of interesting. Like, I know I don't look that old, Oliver, but I've been doing this almost 40 years. Right. So I'm one of those people who lived through periods where we had higher interest rates. And so we're collectively, the world and investors are sort of choking on, oh, my gosh, interest rates are 5%. Well, historically, they're not that high. Right? They just feel high because they've come from zero in a very, very short period of time. And so going forward, those days of, being able to borrow money at almost nothing and throw it at any idea and be able to have enough capital to keep things going, even if they're not working out, I think are over for now. I think assets are going to have to be valued differently. You have to buy high quality assets that produce free cash flow, that are profitable, that can make their way through this. And I think there's going to be a washout for a lot of folks who aren't healthy companies that sort of have survived through this low interest rate environment and now are starting to really feel the full impact of what the Fed's doing.
Understood. All right. Message received. Sean, thanks for the thoughts. Have a good weekend.
Yeah, sorry about the choking earlier.
Hey, all good. It happens to all of us. Sean O'Hara, Pacer ETF Distributors, right? The long healthcare and the avoiding real estate.